Debt ceiling negotiations at a standstill.
United States is on the edge of a fiscal cliff.
And it's time for Congress to act now.
It's happening again. The US is gearing up for another big debate on whether to raise or suspend the nation's debt limit. This raises the question of what the debt limit is, why it's there, and why the US always gets away with it. The risk of default is being increasingly mentioned, but the US debt situation is actually quite different. In fact, it's different from every other country in the world. To put it simply, the debt limit is a cap on the total amount of money the government can borrow. When the US spends more than it makes, it borrows money to pay its bills, including Social Security and interest on the national debt, the latter being the issue we are discussing today. So what happens if the government hits the cap, also known as the debt ceiling? Well, it will need to either borrow money to pay its bills or stop making good on its financial obligations, which most likely leads to defaulting on its debt. Yes, that's the worst case scenario. Now, it's important to note that the US recently hit the limit in January, prompting the Treasury Department to begin using extraordinary measures to pay the government's obligations. Those extraordinary measures just mean raising the debt ceiling temporarily. However, these measures could be exhausted. Now, before you guys start digging shelters for the doomsday scenario, the US is not even close to defaulting on its debt, despite the debt being bigger than the country's GDP. However, it's important to look at the debt situation in relation to the size of the economy. Debt to GDP has gone through 3 growth phases in recent decades due to large budget deficits. The ratio spiked to an all-time high of 134.8% of GDP during the pandemic-caused recession of 2020, but has come down slightly since then. The US has had public debt for longer than its existence as a country, and it's managed to get along without a debt limit for over 150 years. Now, the question arises, how does the US government issue debt? One factor to keep in mind is that the government borrows money to avoid raising taxes, which can slow down economic growth. The government sells bonds to investors, such as pension funds, to raise funds for public services and projects. The national debt is split into 2 types: intragovernmental holdings and debt held by the public. The former is money the Treasury owes to other agencies, like the Social Security Trust Fund, while the latter is what the public owes. Foreign governments own a significant amount of the public debt, including China and Japan. Some agencies, like the Social Security Trust Fund, buy US treasuries with extra revenue they don't need. Owning bonds is a way for these agencies to earn interest and keep the money safe. In January 2023, intragovernmental holdings totaled more than $6.89 trillion, while the public held over $24.53 trillion of the national debt. Despite this large amount of debt, the United States has maintained its status as a global economic superpower. This is mainly due to the strength of its economy and the fact that the dollar is the currency that dominates over all other currencies. I mean, there's not even any competition so far, but we do have to keep an eye on the BRICS countries. You see, the US dollar is a big deal. It's the world's unit of account, which means that more than half of all global trade is done using dollars. This gives the US government and American businesses a lot of power in the international marketplace. One big advantage of the dollar's dominance is that the US can pay off its foreign debts in its own currency. Other countries don't have that luxury, and they have to buy dollars to pay off their debts. This means they have to export more than they import or borrow more dollars on the international market. The US doesn't have to worry about these constraints and can run up large trade deficits without the same consequences. Basically, they can just keep on printing more money. Unlike countries like Sri Lanka and Greece, the US has control over the issuance of its currency. When Greece defaulted on its debt back in 2011, it had borrowed heavily in euros, which were issued and controlled by the European Central Bank. On the other hand, the US debt is in dollars, and the US Fed is the issuer of those dollars. For instance, if the US Treasury needs to issue, say, $50 billion in new debt to finance its debt payments, the problem could easily be solved if the US Fed under Jerome Powell purchases $50 billion in new bonds. This way, money is created out of thin air. This same process applies to any country that borrows in its own currency and controls the issuance of that currency. Japan is one of those countries, and its government has debt over 200% of the country's GDP. Therefore, the US is not necessarily in a debt crisis. As long as the government can control the issuance of its currency, it can always print more money to pay off its debts. However, this can lead to inflation and the devaluation of the currency in the long run, but that's another story. American businesses also benefit from the dollar's dominance. Since international trade is mostly done in dollars, US companies can buy and sell in their own currency. This means they're not as vulnerable to exchange rate fluctuations as their foreign competitors, which gives them a huge competitive advantage. So, is the US in a debt crisis? Not exactly. Even if the government owes a lot of money to foreign investors, it can always print more dollars to pay them back. Now, I'm not saying that's the wise thing to do for economic reasons, but thanks to the dollar's dominance, the US has a lot of wiggle room in international finance. Servicing the debt is one of the federal government's biggest expenses. Net interest payments on the debt are estimated to total $395.5 billion this fiscal year, or 6.8% of all federal outlays. That is a huge amount. For comparison, that's $100 billion more than the government will spend on education, disaster relief, agriculture, science and space programs, and environmental protection combined. That does sound alarming. However, trend charts over time show that despite a recent rise, interest rates on US public debt are still at historic lows. Debt service as a share of federal outlays peaked at more than 15% in the mid-1990s, but generally falling interest rates have helped hold down payments, even as the dollar amount continues to grow. In fiscal 2021, the average interest rate on federal debt was a record low 1.605%. But with the Fed raising its policy rate to try to cool off the economy, the US has started paying more to borrow. The average interest rate on federal debt last year ticked up to 2.07%. So, understandably, with the US breaching its debt ceiling, some are concerned that the country is in a debt crisis. On the other hand, experts say that the strength of the US dollar and the economic condition of the country will never let a debt crisis become a real thing. The US is one of the wealthiest nations in the world, with total wealth estimated at $137 trillion. Sure, the debt burden is huge, but the country's wealth far outweighs any debt issues. Despite the rising interest rates, investors remain confident in the US's ability to manage its debt load. That is reflected in the low yield on government debt due in 10 years, compared to those due in 2 years. The country is safe in the long run. If you made it this far, be sure to like and subscribe for more content like this. The US Federal Reserve has been pushing up interest rates, but the expectation is that rates will fall soon. The Fed is unlikely to hike rates more than expected next year due to slowing inflation. While the US's debt level is cause for concern, it is not currently a crisis. The country's strong economic fundamentals, including a robust and growing GDP, suggest that the US is in a position to manage its debt and maintain its global standing as a financial powerhouse. To avoid an immediate default on its debt, Congress can raise or suspend the debt ceiling. It may sound like a drastic measure, but the ceiling has been raised a staggering 78 separate times. That shows that defaulting on debt is not really an actual problem for the United States. Another way to potentially avoid default is to increase revenue through higher taxes and spending cuts. In the 1990s, the US did this and saw 4 years of a budget surplus due to tax increases, defense spending cuts, and an economic boom. This action helped reduce the national debt and prevent default. Do you think the US government will ever default on its debt? Let us know in the comments.